Traders War Room proudly presents the daily video with the best trading and investing alerts anywhere on any platform. With up-to-date stock, chart, and market news, TWR is simply your one-stop shop. TWR Tech Video. Stay tuned at the end for TWR Hot Products and Services. So today's video, we're going to talk about the U.S. debt ceiling and the markets, what you need to know, and how to prepare your portfolio. So the U.S. could run out of cash to pay its bills by June 1. Treasury Secretary Janet Yellen has warned Congress that if it doesn't raise or suspend the debt ceiling, we're not going to be able to pay our bills by the X date. In response, President Joe Biden has been scheduling meetings with the top 4 leaders in Congress to discuss the fiscal issues. Speaker Kevin McCarthy, the Minority Leader Representative Hakeem Jeffries, Majority Leader Senator Chuck Schumer, and Minority Leader Senator Mitch McConnell, and they will be pressured to reach an agreement to avoid defaulting on the national debt. The U.S. federal debt has almost doubled in the past decade to $3.14 trillion. And you can see this represented in the chart at the top. And that line right there is where we are currently. So economists predict that failure to raise the debt limit could throw the global and U.S. economy into a financial crisis. The portion of the debt owed to the public, individual investors, financial institutions, and foreign governments that lend money to the U.S. is 95% of U.S. gross domestic product. In other words, the amount of money the U.S. government now owes to outside resources essentially equals the size of the entire U.S. economy. Just let that sink in for a moment. Yet, the federal government still doesn't have enough money to pay its current bills and interest on the money it has borrowed, so it needs to borrow more. In the meantime, it has made promises, many enshrined by law, to fund Social Security, Medicare, and other federal government programs. It must also pay interest on the money it already owes. Kind of a rob Peter to pay Paul type of situation. So, in order to understand this, we need to know what the debt ceiling is. Well, the debt ceiling establishes the maximum limit on the U.S. Treasury outstanding debt. So, before 1917, the U.S. government needed congressional permission each time it borrowed money. And during World War I, Congress established the debt ceiling to give Treasury the flexibility to sell Liberty bonds to help finance the U.S. war effort. Here's what those look like. Now, since then, the Treasury, to keep issuing bonds to finance previously authorized government outlays, the limit routinely gets increased. Raising the debt ceiling doesn't authorize new government spending, only Congress can do that via its annual budget process. Increasing the debt limit only affects the ability to pay debts the government has already incurred, including promises bound by law to fund Social Security and Medicare and a few other programs. So, does the U.S. need to raise its debt ceiling? Well, to avoid potentially missing payments to creditors, yes. So Yellen has repeatedly warned Congress that the federal government has reached its borrowing limit. In January, she said that the Treasury would take extraordinary measures to ensure it keeps its making, In January, she said the Treasury would take extraordinary measures to ensure it can keep making required payments to its public creditors. So some of those measures include suspending debt sales to fund certain items and probably should allow Treasury to meet debt obligations through early June. But she also revised that timeline and now has put that X date at 1 June. Yellen urged Congress to act promptly to protect the full faith and credit of the United States. So, has Congress previously raised the debt ceiling? Well, yes. Since 1960, Congress has raised the debt ceiling 78 times, including 20 times since 2001. In recent years, increasing the debt ceiling has ignited partisan bickering, leading to congressional standoffs that push the Treasury ever closer to exceeding its statutory borrowing capability. Now, what would happen if the U.S. defaulted on its debt? Well, a default would mark an unprecedented event with implications not just for the US, but the world over. Never before has the world's leading economy, one that issues the world's primary currency and its safest bonds, failed to meet its payment obligations. Retired adults likely would not receive Social Security checks. Members of the U.S. military, along with federal employees ranging from postal carriers to air traffic controllers, might not get paid. Government food assistance payments may get halted, and checks for government and veteran pensions would cease. If a default occurs, Moody's foresees a cataclysmic U.S. economic downturn comparable to 2008 2009 global financial crisis. And you can see that chart up here where the Dow Jones absolutely got destroyed. And the idea is that a 15 to 25% dump could happen if we default. The economy, Moody said, would lose an estimated 6 million jobs, almost tripling the unemployment rate to 9%, and household wealth would be plummeted by 15 trillion, with a third of the nation's stock market value evaporating. In an environment of raising interest rates, borrowing costs for all types of consumer loans, ranging from mortgages to credit cards, would rise even more, and people would face higher borrowing expenses. Now, even if financial markets and the economy eventually recovered from the default, it would have one lasting damaging impact. Investors no longer would consider U.S. debt risk-free. This is important because for the longest time, it has been known that if you go into treasury bonds and things of that nature, those are pretty much risk-free assets, and no longer would they be considered risk-free as they have for a past century. That would permanently push the federal government's borrowing costs up, making it even more difficult to service its existing debt. Just imagine fixed rates gone, right? Who would invest in debt if not zero risk? Now, how have debt ceiling debates affected U.S. government credit? Well, in the 20th century, Congress usually increased the debt limit with little fanfare. Before 2011, debt ceiling debates didn't hurt the Treasury credit, and it enjoyed the highest rating possible from agencies that assess publicly traded bonds. But amid that year's acrimonious debt ceiling fight in Congress, the Standard & Poor's cut the U.S.'s AAA credit rating, the highest rating possible, to AA plus for the first time in 70 years, and the U.S. still maintains that lower rating as of today. Since then, continued U.S. spending has required Congress to raise the debt ceiling 6 more times, and each time Congress waited until a few weeks or even days before the existing ceiling statutory deadline before raising it. That is the definition of waiting until the 11th hour. Here is a better picture of the AAA rating scheme from the S&P, so you can kind of see all the stipulations, and we are right there at the AA plus, so high likelihood that debt obligations will be honored, which goes into effect that yes, we are just a little bit lower than the top of the top, but we're still pretty up there. Now, how have financial markets and the U.S. economy reacted? Well, in the past dozen years, the periods immediately preceding congressional agreements to raise the debt ceiling have prompted anxiety among investors as the deadline for raising the limit edged closer. Bond prices generally fall as yields rise, and stock prices tend to struggle, particularly in the financial sector, which often uses and accepts treasuries as collateral for loans. Studies by the Federal Reserve found that the 2011 and 2013 debt ceiling episode caused Treasury yields to rise 4 to 8 basis points, pushing the Treasury's borrowing costs up to $250 million each time. You can see by the illustration, this is the S&P at the top and the bond market at the bottom. And what you see is regardless of the deal being made, the market dumps between 15 and 22% on average after it's raised, and then has a slower incline on its way back up to the threshold where it was before. Now, talking about T-bills, right? So excess yields on short-term T-bills during those episodes peaked at 46 basis points in 2013 and 21 basis points in 2011 of the Fed fund. A General Accounting Office report, meanwhile, estimated that the 2011 debt limit fight pushed the Treasury borrowing costs up $1.3 billion for debt maturing that year. Looking back further, a Moody's analyst found that when the Treasury inadvertently missed some T-bill payments in 1979, a mishap caused partially by delays in raising the debt limit, T-bill yields immediately surged 60 basis points and remained elevated for months, raising U.S. borrowing costs by $40 billion in today's dollars. That some analysts found that the uncertainty caused by the 2013 debt ceiling fight cost the U.S. economy over $180 billion in lost output, reducing the gross domestic product by a full percentage point and job creation by 1.2 million. Now, let's go into some advantages and disadvantages of the debt ceiling. So, implementing a debt ceiling is practical, allowing the U.S. Treasury to easily issue bonds without having Congress approve it each and every time the federal government needs to raise money, a pretty cumbersome process. With a debt ceiling, the boundaries are in place for a more efficient monetary approval process. However, the debt ceiling has been notoriously fluid and raised a few times, raising questions on whether it's effective as a tool to ensure fiscal responsibility, and the U.S. has reached high levels of debt over time. So, an easier breakdown of the pros. So, holds the nation's finances in check, can be used to fund federal operations, improves the efficiency in the government's ability to fund obligations, including Social Security and Medicare benefits. The cons can be easily raised, encouraging fiscal irresponsibility, lowers the U.S. credit rating, and increases its cost of debt, and controversy over whether the debt ceiling is constitutional or not. Now, there's something called debt ceiling showdowns and shutdowns. So, there have been a number of showdowns over the debt ceiling, some of which have led to government shutdowns. The conflict is usually between the White House and Congress, and the debt ceiling is used as leverage to push budgetary agendas. For example, in 95, the Republican members of Congress, whose views were vocalized by then House Speaker Newt Gingrich, used the threat of refusing to allow an increase in the debt ceiling to negotiate increased government spending cuts. Then, President Clinton refused to make the cuts, which led to a shutdown of the government, and the White House and Congress eventually agreed on a balanced budget with modest spending cuts and tax increases. So, what about the debt ceiling during the Obama and Trump administrations? Well, President Barack Obama faced similar issues during his 2 terms as president. In 2011 debt ceiling crisis, Republicans in Congress demanded deficit reductions to approve an increase in the debt ceiling. And during this time, the U.S. Treasury debt was stripped of its AAA rating, which we understand that because we had a slide before. So basically, looking at this chart, you got President Obama in blue and you got Trump in red. In fact, in 2013, the government was shut down for 16 days after conservative Republicans attempted to defund the Affordable Care Act, or known as the Obamacare plan, by leveraging the debt ceiling. An agreement to suspend the debt limit was passed within a day, which was when the Treasury was estimated to run out of money. The debt ceiling was raised again in 2014, 2015, and 2017. When U.S. debt exceeding $20 trillion for the first time in September 2017, then President Donald Trump signed a bill extending the debt ceiling to December 8, 2017. The ceiling was later suspended for 13 months as part of a bill enacted in February of 2018. The ceiling came into effect and was increased again in March 2019 when U.S. government debt topped $22 trillion. In August of 2019, then President Trump signed the Bipartisan Budget Act of 2019, which suspended the debt ceiling through the 31st of July, 2021. This legislation also put caps on federal agency budgets while I can't say that, ensuring that the government could pay its bills in the short term. Now, with the debt ceiling exceeding $20 trillion for the first time in September 2017, then President Donald Trump signed a bill extending the debt ceiling to December 8, 2017. The ceiling was later suspended for 13 months as part of a bill enacted in February 2018. The ceiling came into effect and was increased again in March 2019 when U.S. government debt topped $22 trillion. In August of 2019, then President Trump signed the Bipartisan Budget Act in 2019, which suspended the debt ceiling through July 31st, 2021. The legislation also put caps on federal agency budgets while ensuring that the government could pay its bills in the short term. Now, Democrats will never admit this, but I remember when this happened, and it was actually one of the smoothest. In fact, suspending the ceiling in this manner eliminated the risk of default for another 2 years, increasing spending to $320 billion for 2020 and 2021 fiscal years. The debt ceiling was once again raised to $31.4 trillion in December of 2021. Now, let's talk about newly appointed House Speaker's effect on the debt ceiling. Some economists and Wall Street analysts believe the recent election of California Republican McCarthy to House Speaker raises the prospects that lawmakers may vote against lifting the debt ceiling later this year, increasing the possibility of the U.S. defaulting on its debts. As part of their support to install McCarthy, conservative fraction Republicans have indicated that they would vote against raising the debt ceiling without significant federal spending reductions, seeing the political gridlock that could destabilize the financial system. And currently, this is the biggest issue right now between the two parties. Now, even with all the issues that are going on with these current negotiations, the debt default still remains unlikely. And despite the ongoing political brinkmanship in Washington over this debt ceiling and spending cuts, it remains unlikely that the U.S. will default on its debts. President Biden successfully made deals with Republicans in 2021 to pass critical legislation, most notably the $1.2 trillion infrastructure package, and therefore is likely that he will negotiate spending reduction measures with White House Republicans in exchange for raising the debt ceiling. But the deal is being attempted to be made without the POTUS intervention. If he gets involved and utilizes tools, it's not seen as a victory. Now, Insight and Market Perspective site AGF projects a 60% chance of Congress striking an 11th hour deal to avoid default, indicating the likelihood of macroeconomic uncertainty in the months ahead. And so the current debt ceiling is $31.4 trillion as of October 2022, and it's needing to be raised. And it was raised by President Biden in 2021. Now, at the bottom, right there, that is the national debt clock. And if you've never seen this thing in action, do me a favor. Check it out, like in the morning, put it on your computer and take note of the debt, and then look at it again at the end of your workday, and you will be astonished at how much just within 8 to 10 hours of debt that the U.S. takes on all the time, guys. It's crazy. And so it's interesting to see this because the debt ceiling is the amount of debt that the U.S. government is allowed to incur. And as of October 2022, it's at $31 trillion and rising. And this clock keeps track of it, and it's amazing of how it just keeps going up, guys. All right, so TWR conclusion, right? The debt ceiling was created during the World War I to regulate U.S. government spending and keep the U.S. government physically responsible. Since then, the debt ceiling has been raised or revised 78 times to avoid the possibility of default and keep the U.S. economy running, with no signs of Congress turning to other options despite questions over the debt ceiling's effectiveness. It would be completely unprecedented to allow the debt ceiling to default, especially since there are tools available that can extend and suspend for short periods of time. My guess is that they will kick the can down the road and will come to some kind of agreement in the very last minute where each side will claim victory and it'll basically get back to business as usual. Now, I do think the market will see some type of volatility, and as we've seen previously, even after the debt ceiling deal has been made, the market usually takes a tumble, and I'm expecting anywhere between 15 to 25% drop in equities. So head on a swivel, guys. Ensure you have dry powder on the sidelines so that you can pick up some stocks on deals of your favorite companies that you want for long term, and we will ride the trend and momentum and continue our assault. No matter which direction the market goes, we're going to absolutely destroy it. And as always, let's go to war together. Upcoming events. Join the TWR Investment Club. Are you tired of trading alone? Losing more than you're winning? Or are you just too busy with work, family, and life to focus and hit the market bullseye? If that's you, then join the TWR Investment Club. We trade the account for you and then pay you profit and loss distro. We run both a 30-day and a 6-month club. The next club round starts 1 June, and the link to join the free chat where you get all the information is in the description. Our next class is set, guys, on 11 June at 1 p.m. Central Standard Time. TWR is going to teach you Sports Betting 101, how to pick and bet the winners from the losers. Our instructor, Tech Bets, is the best analyst you've never heard of. He's the total package, guys. He has a great win percentage, great picks, and great knowledge. And he's only on TWR. He's going to teach you the basics and the strategy that makes bank betting on live sports. So, sign up today right there at traderswarroom.com/upcoming classes. And as always, the link is in the description. I will see you there. Activate your 2-day trial of TWR All Access on the Discord platform. We cover it all at Traders War Room, whether you're looking for stocks, options, futures, Forex, crypto, or even sports betting, or you want real-time alerts, live trading, algo signals, or even if you just want to be part of a community of like-minded investors to grow, learn, and share together as a team. Something for everyone, every budget, and every style. Join TWR today and trade with the bulls. The market is our war zone and stocks are the battle. Join TWR and let's go to war.